Is now starting. All attendees are in listen-only mode.
Thank you all so much for joining us here on CPA Academy. This is Jason Bookman speaking, and I am happy to welcome you into today's session on ERC Audits. Are you ready? Today's webinar presenters are Rebecca Sheppard and Peter Haukebo of Frost Law. And before we get into their presentation, I want to check with all of you in the audience, make sure that everything's working for all of you, make sure that everybody can see and hear. I see a lot of you are already sounding off in that questions panel, but those of you who haven't done so already, head on over to the questions panel in the webinar interface. Let us know that you can see us on camera, that you can see the slides, and that you can hear my voice. And feel free to let us know where you're listening in from. We always love knowing where you are, and it's a great way for us to know that everything is working with the webinar software. I'm seeing people checking in so far from all over the country. People from Washington to Florida and everywhere in between. Thank you all so much for letting us know that everything's working. And now that we know everything is working, we can move into some other aspects of the webinar housekeeping. This questions panel that you're using to check in is also there for your questions for our presenters throughout the webinar. If anybody does have any questions, put your questions in that questions panel. If there is time during the webinar, we will have Peter and Rebecca answer those questions likely towards the end, but because of the time constraints, not all of your questions may be answered live on air. So all of your questions that are asked and all of your comments that are made in the questions panel will be forwarded over to our presenters at the conclusion of the webinar. This questions panel is also there if anybody's having any technical difficulties with the webinar software. If anybody's having any trouble, let me know in that questions panel and I'll do the best I can to get around to all of your troubleshooting as quickly as possible so we can put your focus where it needs to be. Moving on to some quick housekeeping about polls and credit for this webinar. This webinar qualifies for 1.5 CPE credits and 1 CE credit for IRS enrolled agents and PTIN holders. The way you earn that credit is straightforward. You need to stay logged in for at least 75 minutes and answer at least 5 of the 6 polling questions that will be offered throughout the webinar. When the polls come up, the poll box will replace the presentation, and all you need to do is hit the button corresponding with your answer and then hit the submit button to confirm your response. Our team here at CPA Academy will get to work on issuing your CPE by the end of the day today, and we will register your CE credit with the IRS at a later date. If you are an enrolled agent or PTIN holder, please make sure that your name and PTIN are input in your CPA Academy accounts the same way that they are with the IRS, in order to minimize any difficulty we may have reporting your credit. CE credit will be registered with the IRS at a later date, and for any questions about the reporting of CE credit or any general questions, please feel free to consult our CPA Academy FAQ page on our homepage at cpaacademy.org. Now that we've gotten through all of the housekeeping, we know that everybody can see and hear. I'm going to switch my camera off and turn things over to our presenters. So Rebecca, I believe you're speaking first, so thank you both so much for being here, and let's get started.
Thank you so much, Jason. We are super excited to be here as well. Just to give you all a little bit of background on me and Peter, we are tax controversy attorneys, and we've been tax attorneys for about 12 years each now. And prior to the pandemic, what we would do is help small businesses with tax defense, essentially. Audits, large payroll tax liabilities, employment misclassification issues, and things like that. When the pandemic began, we knew that these clients that were kind of on the bubble of viability weren't going to be able to withstand closing for any period of time or any type of restriction, frankly. And so we dug down deep into the CARES Act and started with PPP and helped our clients through that process. Now, in the beginning, it was much more complicated than it kind of turned out to be as the guidance kept getting issued. I remember specifically there was a Friday night where guidance was dropped the Friday before Memorial Day weekend at like 7 p.m. And Peter and I had a presentation at 10 a.m. on that Tuesday. So we had to work that weekend to make sure we had everything updated properly. But if you all remember, in the beginning, you had about 8 weeks to spend more than 8 weeks of salary. And so it was kind of complex in how to make sure your clients could properly get these loans forgiven. And then by the end, you had 24 weeks to use it, and sole props could use it, and independent contract, everyone with a much more forgivable policy and procedure than it began out as. Now, in the beginning, you could not use PPP and ERC together. And so we put ERC kind of in a box. I had one client use it over the summer in 2020, but everyone else was PPP. And then in December of 2020, Congress changed the rules. And what they said is you can use ERC and PPP together, you just can't use the same dollar twice. And that changed the game for us. And so we started looking at our clients to determine who could be eligible for this program. It also increased the credit from about $5,000 an employee to as much as $26,000 an employee if the employer was eligible throughout the period. So we worked with our clients that were eligible and got them ERC, which wiped out a lot of their full tax liability, which was amazing. And in addition, some of them even got refunds on top of that. It was such an incredible program and really helped our clients kind of get a fresh start in the operations of their business, especially in this kind of like new COVID world. So then Peter and I realized that we were going to be able to help businesses that weren't on the bubble of viability, and kind of started this educational campaign to help business owners, help CPAs, help EAs, help everyone do this right, do it properly, and make sure that people are properly taking advantage of the credits while staying within the rules. All of that, I hand it over to Peter.
All right. Hello. All right. So look, the goal today, yes, is to talk about ERC audits, what we anticipate, what we're seeing, what we're hearing, what our understanding of the landscape is. But we're going to build some fundamentals too, and go through the background of the credit, talk through, stuff we're seeing, and then, ultimately talk through some of the issues that we think the government's going to be looking at in these audits. Big picture, we're starting to see some audits happen and some investigation of this stuff. So it's important to be prepared. So just background, Rebecca touched on some of this stuff, just to start, remember all the stuff that was out there. A lot of it was CARES Act, but there was subsequent legislation. And so, Paycheck Protection Program was the big one that really took all the air out of the room for a lot of these things. And certainly ERC at the beginning. Paycheck Protection Program was worth, $15,000 and change per employee. And I think got up to $20,000 and change after some of the changes in that program rules. There was also the Family First Coronavirus Response Act. And I'm mentioning these because they're going to come back up later. So, FFCRA was a situation where if you got sick with COVID, if you were caring for a close family member who got COVID, employers who were paying wages could claim tax credits. There were deferrals of employment taxes where half was due December 31st of 2021. The other half was due December 31st of 2022. So these should have been repaid by now. The employee retention credit was part of the initial CARES Act. It was just only worth $5,000 per employee. And the initial program rules were pick a lane and pick between PPP and ERC. And it was really only those employers who were eligible for the Paycheck Protection Program. Rebecca mentioned she had, one of her clients, we were working through this stuff in 2020. Then they came out with, some more specific things, industry specific, restaurant revitalization fund, shuttered venue operators grant. There was grant programs for airline industry, all sorts of stuff. Economic injury disaster loan was the other big one, where basically the president said every place in America is a disaster zone. And that opened up some pretty favorable funding from the SBA. ERC specific legislation, this is it. This is the universe of stuff that Congress has said about ERC. So the first one was the initial CARES Act. That was March 27th of 2020. But then, as Rebecca said, that flipped it on its head to December 27th, 2020 with the Relief Act. Then you have a new Congress, a new administration come in, and they pass the American Rescue Plan. That was March 11th of 21, generally making, this easier to get, more lucrative. It went into quarters 3 and 4 of 2021. And then mid-quarter, they pulled the rug out. And they said, well, just kidding, you're not actually going to get it for Q4. So look, Congress has been active in this space. This is the legislation that they passed. This slide really is the universe of what agency guidance we've received, what the interpretive guidance of what Congress passed. And Notice 2021-20 is certainly the most informative. 23, 49, 65, those sort of track the legislative changes from Congress and add a little bit more color. These revenue procedures, 2021-33 and 48, deal with some of the other COVID-related programs and grant programs. So we'll talk through, some of those issues, but that's it. That's really what we know about ERC. Now, we'll point out that a lot of this is built on existing tax law, and you need to have a real firm grip on, a lot of fundamental tax stuff to make sure that, you're able to work through issues with auditors, revenue agents, or even if you're still, processing these and working with taxpayers in the front end also. And with that, I will pass it back to Rebecca and mute myself.
Thank you. Okay, so what is the employee retention credit? We know this is more of an advanced course, so we're not going to spend a ton of time on this. But if for some reason you don't have this information, the audit info is not going to make any sense. So the employee retention credit is a refundable tax credit, and people get this confused all the time, not like yourself, but operators do. And something just to make sure that you point out when you're talking to your clients, you're not talking about a carry forward credit that's going to take 25 years for them to fully get the value out of. You're talking about a refundable credit that's going to be paid per quarter of eligibility in the form of a check from the government. You're eligible for 5 quarters. The client is going to get 5 checks from the government over a period of, God knows, 2 months to 1+ years. So what is it? In 2020, an eligible employer is allowed a credit against applicable employment wages equal to 50% of qualified wage up to $10,000 for the entire year. So the most you can get per employee is $5,000 for 2020. That's one of the reasons why people just weren't paying that much attention to it in the beginning. It was nice, but PPP was better, and for $5,000, some people felt it wasn't worth it. Then 2021, Congress made this credit much more lucrative. Instead of 50% of up to $10,000 in qualified wages, we're now looking at 70% of up to $10,000 in qualified wages per employee per quarter of eligibility. So this makes the credit go from $5,000 an employee to maxing out at $26,000 per employee. Now, I may have seen one credit that maxed out at $26,000 per employee. I mean, that's not common, but it's happened and it's possible. And so understand that that's kind of the range of possibilities for your clients. The next slide. Okay, so how do you get it? How are you determined to be an eligible employer? First, you have to be carrying on a trade or business during the calendar quarter for which the credit is determined. And there's 2 ways to qualify. First is a significant reduction in gross receipts. So for 2020, the gross receipts are less than 50% of the gross receipts for the same quarter in calendar year 2019. Now, for 2021, when they made the credit better, they also made it easier to get. Instead of a 50% decline, which is very hard to get, you're looking at a 20% decline. And there's an alternative reference period for 2021 quarters that allow for automatic qualification for successive quarters. So what that means is if in Q1 of 2021, you go down 22%, and then in Q2 of 2021, you go up 1,000%, your qualified wages for Q2 are still eligible to be counted for ERC. Now, this is a really hard concept for some people, and Peter and I have had to send lawyers, case law, like explain it, show the rule, how this qualifies, to have businesses understand that this is how the rule operates. There is no test like there is for PPP with the employee retention credit. There is no, did my business need this money? Is there a reason I'm asking for this money? This is a tax credit like any other tax credit. You put in energy efficient bulbs in your house, you get the $2.50, whatever it is, you're eligible for it based on these qualifications. There is no other like significant test or metric to measure in order to determine whether or not you should apply for the employee retention credit. One other point to point out just quickly on gross receipts is that the reduction in gross receipts does not need to tie to COVID-19. We have clients that closed 13 locations in January of 2020, which gave them eligibility for all of these quarters because their revenue went down significantly. Not because of COVID-19, but because their revenue went down. The revenue test is just the revenue test. There is no COVID-19 component, and that client was eligible. Next slide. So then there's the full or partial suspension of trade or business operations. This is where Peter and I spend, I usually say 85% of my day, but it's a lie. I tell myself it's probably 95% of our day, going back and forth about whether or not somebody was fully or partially suspended due to a governmental order that was issued because of COVID-19. So the rule states the operation of the trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes due to the coronavirus disease, 2019. So you can go to the next slide. It's a facts and circumstances test. If your business is closed, or if a portion of your business is closed, let's use a restaurant as an example because it's the easiest one and everyone can kind of picture how this would work. Restaurants were open. I live in the state of Maryland. Governor Hogan said restaurants are essential. They're open March 16th, 2020. Please go visit your restaurants, but you're not able to go sit inside. You can't have any indoor dining. So a portion of their revenue was completely suspended. You couldn't do anything in that time. To determine whether or not that portion is more than a nominal portion of their business, you need to look at 2019, Q2 of 2019. Did the restaurant have more than 10% of their sales or their hours worked in the dining room, in-person dining? If that is the case, then they're going to satisfy that test, going to be an eligible employer. It does not matter if their revenue went up because of carry-out sales, because of putting in a drive-through, or DoorDash, starting Uber Eats, whatever these companies did to stay afloat. The fact that their revenue went up doesn't matter because a portion of their business was fully suspended. Now, that gets much more tricky when in about the summer of 2020, Governor Hogan said, okay, indoor dining can resume, but we're going to put these restrictions on it. We're going to put these modifications. There's going to be a capacity restriction. People are going to have to be 6 foot socially distanced. How many people can you fit in your dining room? Is it half? Does that change the test? The test now goes from a look-back test, where you're looking at 2019, to determine whether or not these restrictions or modifications had more than a nominal effect on the restaurant's ability to provide goods and services. Now you have to look at that drive-through, and you have to look at that carry-out sale and say, hey, looking at the overall picture, does this capacity restriction actually still have more than a nominal effect on the business's ability to provide goods and services? And that's a tough question. It's hard to know that, and you have to really drill down to talk to your client. Now, all of this is before the audit, right? Hopefully, when you're preparing these claims, you get really into the weeds and you talk to your clients and you have these conversations about nominal portion and nominal effect. A gross receipt audit, I think, is going to be pretty clear as far as where the revenue comes from and whether you met the requisite percentage down. But this is going to be hard, and this is where you're going to have to be discussing this stuff with your client beforehand, and then with a revenue agent, if you are selected for audit.
Jason,
you want to add
this may be a good place for a poll question if you're around.
Oh, yeah.
You read my mind. I was just about to jump in. Thank you so much. And with that, we have the first poll question up. So we're going to leave these polls up for about a minute each. This is the first of 6 polls. Of course, there's no right answer to this poll, but you have to select a response and hit the submit button for it to count towards your CPE or CE credit. The question, have you filed a Form 941X to claim the employee retention credit? Go ahead, get your answers in, and we're going to leave this up for about 30 more seconds. This is poll number 1. We will have 5 more polls after this in our remaining time. Got about 15 seconds left in this one, and thank you all so much for voting so quickly. Get ready to close out of the poll in just a few seconds. Get your responses in if you haven't already as we close out of this first poll in 3, 2, and 1. All right, poll is closed.
Awesome. There's not another slide, on this, but this is where this stuff gets really hard. The nominal effect stuff. Analyzing to understand, did it have a more than nominal effect on trade or business operations? Rebecca mentioned it's a facts and circumstances test. They've said they will deem it to have a more than nominal effect if you can establish that your ability to provide goods and services in the normal course was impacted, right? And that impact was more than an annoyance, more than a nuisance, right? It has to be more than nominal. They're using the word nominal, right, and applying a 10% test, but working with clients to make sure that they are documenting what they would pass across the table to a revenue agent who's completing an audit. How are you establishing these things? And you've got to work with taxpayers on these issues because it's sort of a sliding scale here where the gross receipts, for the most part, is a black and white thing. As long as you're analyzing it according to your established method of accounting, cash basis, accrual basis, and you're booking things in the right calendar quarters, you're pulling quarterly P&Ls, and it's pretty straightforward. When you're analyzing something that is completely closed, and restaurants are a great example, well, if I can segregate my sales to my indoor dining, and I can establish that was a more than nominal portion by the amount of sales that were coming in 2019 from that portion, even that's pretty straightforward. But now when you're trying to establish this more than nominal effect because of these governmental orders, you always have to bring it back to these governmental orders and understand, how did these governmental orders that were operating on my business, how did it mess things up? How did it force me to change the way I was practicing, and did that have an effect? You've got to be able to talk about the effect, establish the effect, get some numbers behind it, get some data there, because they are asking for this stuff in these audits. So there's not a separate slide on this. We'll go through some more of the technical issues, I think, on audits, but this is ripe for evaluation as well, I think. Moving on, there is a third method, and this is actually the only method that the government would actually understand the theory of the case. So when you file these 941Xs, if you haven't seen them, I mean, it's what, a 5-page return with very little information that is filed on it. I think we've got the worksheet 2 in here as a slide. There's very little information on that, where some of the computations are happening. The first line is in and of itself a conclusion for all the work that's done off of the government forms. Method 3, recovery startup business, there is actually a checkbox. So this is really the only one that you're identifying the theory of the case for the government. there's just some definitional issues here. So by definition, trade or business operations began after February 15th, 2020. The average gross receipts of the business were less than $1 million annually. We'll talk in later slides about what to think about controlled groups of corporations when that stuff comes up. By definition, for these, you don't qualify under method 1 or method 2. This credit is only available for Q3 and Q4 of 2021. So, policy-wise, what's going on here? Well, you started a business during a pandemic, you took a risk, you survived into Q3 and Q4 and had employees in those quarters. They're going to say you're eligible for employee retention credit. The catch is each quarter is capped at $50,000 for credit. So if you're qualifying based on a recovery startup business analysis, you're talking about $100,000 max. All right, so for the longest time, and we laid out the legislation, the notices that came out, that was all that the government had said. And as tax attorneys, we sat back and we were doing this stuff and working with our clients on these cases, but we also saw an industry pop up overnight dealing with these credits. And you saw people who pre-pandemic, they were swinging a hammer, right? They were building houses. They were, doing anything but tax or working with IRS issues or anything like that. And what has happened is there's these pop-up shops, there's these ERC mills that are out there. And finally, October 19th last year, the government IRS came out with a warning saying some third parties are taking improper positions related to taxpayer eligibility for and computation of the credit, and reminding everybody that improperly claiming ERC could result in taxpayers being required to repay the credit along with penalties and interest. That was really the first statement from the IRS in a while about it. We were at the American Bar Association's tax controversy and tax fraud convention in Las Vegas in December, and representatives from the government come, and there's a civil enforcement panel, there's a criminal enforcement panel, and both are there talking about ERC and saying we're going to add this to the dirty dozen list. What's the dirty dozen list? You all probably are aware, but each year the IRS comes out with a list of 12 issues that they said they're aware of, they're looking at, and reminding the general public to be aware of it and make sure that they're not being taken advantage of by some of these companies. They opened the 2023 Dirty Dozen list with ERC, and Office of Professional Responsibility came out with a statement regarding ERC. There were several follow-ups actually during that week or so when they rolled out the Dirty Dozen list. So certainly IRS is aware of the junk that is out there, and that these ERC mills are up and running and taking very aggressive positions, if not positions that are wholly ungrounded in the law or in the interpretive guidance that's come out. So if you're doing this work, make sure that you're slowing down, appreciate the nuance, work with your clients, understand what they had going on. The hardest part about all of this is that I can read the law and the legislation. I can go and look at the governmental orders and evaluate those and look for shall language and not should language and all that kind of stuff. But the really hard part is that I didn't know that taxpayer back in 2020 or 2021. You didn't know that person back during the pandemic. They're coming to you now and saying, hey, can you help me with this? But you've got to work with them to understand, was their reality during the pandemic really something that creates eligibility for the employee retention credit? So before we go further, I just want to make sure everybody considers this soberly, because there's a lot going on with all of this stuff, and it is hard. Rebecca, back to you.
Actually, before we get to Rebecca, is it okay if we go into another poll?
Yeah.
It is. This will be poll 2. People are asking in the chat how many polls we've done.
Yep, this is
Did
the
we get the
second
results
one.
from poll 1? What were the results?
Oh, I can share the results from poll 1 right after we close this one out. In the meantime, this is poll 2. We will have 6 total polls, so that is 4 more after this one. We leave each poll open for about a minute. Go ahead and get those answers in. Of course, we will get to all 6 polls in the time of this webinar, so get those answers in. This is poll 2. We will leave this up for about 30 more seconds, a minute total each for all 6 polls. The question for this, have you been contacted by a client about an ERC audit? Go ahead, get your answers in. So far, the majority of the audience, about 64%, is saying no, they have not been contacted by a client about an ERC audit. Get those answers in. We're going to close out of this poll in 3, 2, and 1. So for this poll, it ended with 63% of the audience say they had not been contacted. 19% said yes, 17% chose NA. For the first poll, the question was, have you filed a Form 941X to claim the employee retention credit? 42% each said yes and no, with 16% saying not applicable.
All right. Thanks, Jason. All right, here we are. So that's the basics. There's a lot of questions in the chat. I had originally said I wanted to go through them to make sure everyone understood, but I think it's going to be a challenge. So look at the last one that just was written, which is it total gross receipts declined by 20%, or it can be a category such as catering, for example. No, it is total. And Peter's going to get into this more when we talk about control groups. But everything is going to kind of roll up into one single employer depending on how the organizations are structured. So you definitely can't segregate income streams to use the gross receipts test. Audit basics. So we don't have this as a poll question, but I assume a lot of you have some familiarity with IRS audits, or if not, maybe this will be time for you to get involved. But usually the first contact is a letter from a revenue agent asking for a whole bunch of stuff. And although no claims that we have filed, at our firm have been audited yet, there's some going through around in our our credit work groups that we're a part of, throughout the country. And so we pulled it off because we figured that you guys would be interested to see what the IDR says and what the IRS is looking for. So essentially, and we'll get into this when we talk about substantiation, but like any audit, you want to make sure that you contact your client, let them know what's going on, go through the IDR with them. If you've prepared the ERC claim, it's going to be a lot easier for you because you're going to have hopefully all of this information. We didn't say this before, but when we actually prepare these claims, we give the client a whole bunch of information. We give them a big packet, a deliverable, and that's going to say why we think they're eligible, written down based on what orders. We're going to have government orders as an addendum to that. We're also going to have work papers that's going to show like a PPP offset or RRF offset, along with the forms. And then we ask the client to review all of it together to make sure they agree to our theory of the case. Putting that packet together is essentially going to be that first response to the IDR. Most likely, it's going to be that revenue agent is going to say, why are you eligible? Is it gross receipts or is it governmental orders? Governmental orders, provide them. If it's gross receipts, show us your P&Ls and your bank statement. So all that information should already be there if you're the preparer of the ERC claim. And if you don't have that, make sure that you start doing that as a best practice. Make sure that you give them to your client so that they have it in case they don't communicate with you for an audit. But definitely make sure you have it in your files as well. It's going to be very important. And then the other questions are going to be, okay, how do these governmental orders have a more than nominal effect? Or did they, impact a nominal portion of your business in 2019? You're going to have to explain it to the Internal Revenue Service. It goes through. So this is just kind of for your own information to keep in the handout. Hopefully you'll be able to expand this and use a magnifying glass and read it a little better than I'm able to on the screen. Okay, so Peter's going to kind of go through what you need to do to prepare and to submit an ERC claim. What should you have in your files?
Right, and the big takeaway from this is, from what we've seen so far, the IRS is asking for exactly what they said they were going to ask for. So I said previously, the really important notice is Notice 2021-20, question and answer 70. They sort of throw out a question and answer it is the format of that document if you haven't seen it. So QA 70 essentially says, what do we need to substantiate the claim? And that largely tracks to that IDR we just looked at, but this list. So if you are qualifying based on a full or partial suspension of trade or business operations due to a governmental order, well, they're going to ask for the governmental order. Bear in mind, these things were like up for 2 weeks, right? We were just going to slow the curve or slow the spread. And they had to be renewed and renewed and renewed. I think you need to get all of those to be able to trace from this start date, because that's what's going on here. Is you've got two things going on with the credit. One is eligible employer analysis. That's largely what we've talked about so far. Then you've got to get into qualified wage analysis. But the eligible employer analysis is a very specific date and time that eligibility starts, and a very specific date and time that eligibility ends. Then you sort of overlay that start period and end period with, the qualified wage analysis and the computations and the math stuff. But understanding when a business was actually restricted, you've got to go back to those governmental orders. You've got to read the language. You've got to make sure that it says shall and not should, or understand, frankly, the operation of several layers of orders where, you've got a state order that is making suggested language, actually restrictive on a business. And so working through those things, these can be hundreds, if not thousands of pages of paper. And believe me, the orders are starting to come down off the internet. We use the Wayback Machine in archive.org in our practice way more than I ever thought we would. But this should be something that you're providing to your clients, and that your clients should be asking for. They should want to review these things to make sure that, again, this was their reality. These were the things that were impacting them. If you are qualifying based on a significant decline in gross receipts, you got to show evidence of it. Generally, that's going to be a quarterly P&L that you're comparing in calendar quarters in 2019 to calendar quarters in 2021. But again, it's dollars in the door net of allowances and refunds. So it's a top line number, but you got to make sure it's booked to the right calendar quarter and according to your method of accounting. Records of qualified wages may actually be the easiest thing because it's largely payroll data. Understanding when payroll was run, those dates are important. You're going to want to show all that stuff. We haven't talked about it yet, but there are distinctions and nuances in this about whether or not you were a large employer. So on average, in 2020, if you had more than 100 employees, 100 full-time employees, or they bumped the number up to 500 for calendar quarters related to 2021, it changes the definition of qualified wages. And now you've got to show that you were paying wages to someone who was not otherwise providing services to the company. And we'll talk about that more. But now you're in a situation where you have an absence of evidence. I mean, you're probably going to go and pull schedules from when people were scheduled to work, right? We haven't talked about it yet either, but health plan expenses. So those pre-tax dollars that an employer is paying on behalf to sponsor a plan, those can be used as qualified wages. So those can be helpful when there are PPV offsets. You can't otherwise get that qualified wage number up to 10,000 per 2020 or 10,000 per quarter in 2021. But you need to get that information, and you need to understand what is attributable to each employee. So it's not just a top line number. You're really going through and getting into the weeds of understanding how much an employer is paying to sponsor for Bob, for Rick, for Mary, all these different people. Aggregate group employer determination. So we will definitely be talking about this, but ERC is overlaid on top of existing tax law. Section 52, 1563, these sections that deal with controlled groups of corporations, 414 with affiliated service groups, can affect the way the credit works. And we'll talk through some of the detail there, but you're going to need to be able to respond to questions about, what does this owner also own? What are the other businesses? What is a spouse involved in? Because it changes the way this all works. And then, of course, they tell you to keep copies of your employment tax returns. They say keep it for 4 years. I mean, we're sort of watching what Congress may try to do, because there's been some suggestion that they might want to increase the statute of limitations for audit to be able to look at this a little bit longer, because the audit period is closing quickly, and there's a lot of people. I think it's probably 2 or 3 weeks old at this point, but they came out, IRS came out and said we're 961,000 forms 941X behind. Some of those can't be processed because we're also 150,000 just 941s behind. And so there's a lot to look at in a relatively short period of time. This I mentioned previously. I think this is still me. This is worksheet 2. Notice in the upper right-hand corner it says "keep for your records." This is where a lot of the magic happens as far as the computations, but it's not even filed with the government. So what is actually on that 941X? There's not a lot for the government to understand or to realize. And even a lot of the stuff that makes it to this worksheet is done, off of any government form, and this is going to be an interesting audit process because they don't have a lot of the stuff as even a starting point.
So a lot of times people will call us and they'll say things like, I'm approved, I just want to run it by you, or I've got this call, I am eligible for this amount of money. I had a potential client call me, and as a tax controversy attorney, she was like, Rebecca, I owe $1 million. I need help. Sure, fine, absolutely. Why do you owe $1 million? First question. Oh, I claimed the employee retention credit for $3.8 million. I claimed it on my income tax return. Now I owe $1 million. Did you get your money yet? No. Okay. That's like, who gave you this advice? Like, first step, that's not great. Secondly, do you know you're eligible? And she was like, I'm definitely eligible. I was impacted. How were you impacted? Well, I couldn't do things the same way. What does that mean? Do they give you government orders? How you made a claim for $3.8 million? Are you sure? This is a good time for us to take a look and make sure you're eligible, because you haven't gotten your money yet. And it's a lot easier to send back a check when you just got it than it is 2 years later to send back a check, especially when you're paying $1 million in income tax. That's going to be a real big challenge that we'll see if they extend the statute for audits, but they don't extend the statute to amend your income tax return for a refund. That's going to be really problematic if you're winding back some ERC and then people have already paid income tax on those liabilities. People think that when checks are issued, the IRS has approved their claim, and it is incorrect. They think it's like PPP, where SBA gave them a stamp of forgiveness and everything is okay to go. And that's not the case at all. What's happening here, like Peter said, is it's a tax return with very little information on it. You don't know how many employees they had. You don't know really anything. It's a matter of a processed tax return generating a refund that can possibly come back for audit. And that's why it's so sticky. Okay, so before you are audited, before you go through this process, you want to make sure you're digging deep into these governmental orders. And like I said, this is really where Peter and I spend a ton of time. We have legal meetings with 13 lawyers on a call, and we'll be arguing over or not whether or not something has a nominal effect, whether or not something is a governmental order. What does it mean? And there's some places that say CDC guidance is a governmental order. And that's definitely not on its own the case, right? It said this is what businesses should do. It's not a requirement. So how do you determine whether or not your client has a restriction based on a governmental order? Well, first you need to look and see if the governmental authority is from the US. There's some outfits that are saying like foreign orders count. They do not. State, local, federal. It can be, you know, the health county of XYZ town, but it has to be an official governmental order. So this goes through like what counts as a governmental order and what doesn't count. You know, somebody getting up at the mic and saying, keep your people safe, socially distanced is not a governmental order. A declaration of a state of emergency is not a governmental order. A potential client called me last week and asked me to write a letter saying that her business qualified for the employee retention credit. She didn't want to get into it too much, but basically all Maryland businesses qualify because there was a stay-at-home order. I said, no, that's not the case. And no, we won't write a letter. And this is not the proper way to do something. We're happy to look at your claims, but we can't. A stay-at-home order does not give you the authority to say that there's a governmental order that's restricting your business. And this is what the FAQs are really about. If you spend the time to go through them. Does a salad bar getting closed down in a grocery store count? You know, in whether or not that's like a true restriction or not.
And just quickly, I mean, I think the two key things are, one, that the governmental order has, that the person issuing or the body issuing the governmental order has jurisdiction over the business. And secondly, that this governmental order is in response to COVID. Those are really the two things that we're looking at. And so I just want to pause because I'm a little bit triggered about the OSHA bullet here. We're not suggesting that eligibility is generated from you know, OSHA and the general duty to keep employees safe or anything like that. Just that there are some limited circumstances where state OSHAs could have issued governmental orders. This is all very fact specific and something that if you're doing, you need to pull and present to the client and work through, again, pre-audit, right? If you're still filing these things, you know, if an audit happens, you've just got to pull them all out.
Okay.
Before we go to the next slide, just want to jump. Is it okay if we go to another poll real quick?
Sure.
Great, thank you so much. This is the third poll throughout this webinar. We will have 3 more polls after this one. Go ahead, get your answers into this third poll. We'll leave the poll open for about a minute total, so that's about 45 more seconds from now. Don't forget to hit the submit button so that this poll will count for your CPE or CE credit. The question, do you get in arguments with colleagues about the nominal effect analysis? Go ahead, get those answers in. So far, the majority is saying no, followed by NA.
I say yes.
So this was Peter's question. This is truly what we do, and so I think he just wants to know if there are other friends like us that we can pull into our nonsense. But if not, that is quite all right. It does not mean that you're not doing this correctly. It just means that we're very opinionated, I think.
And of course, there are no wrong answers to this poll, so go ahead and get your answers in as quickly
I
as
know, it's
possible.
okay. We know it's probably just the two of us.
The poll is for the attendance check and for the CPE and CE qualification. So with that, I'm going to close out of the poll in 3, 2, and 1. It looks like 49% of the audience said no, 36% said NA, and the combative 14% said yes.
All right, those 14%, you sound like our people. So definitely reach out afterwards and let us know if you'd ever like to have a coffee or something like that, because even, you know, a virtual coffee, we'd be happy to pick your brain a little bit and see where you are in this process. Okay, so one big issue with this, Jeff, is that the orders are coming down, right? You're having changes in administration. Like Peter said, we're using the Wayback Machine. So it's hard to find the governmental orders. And you might find one and then one 9 months later, and you're unclear about in between, because the orders could be for 5 days at a time. Just because of the way this was going in 2020, people were updating things constantly. This goes into effect for 7 days until something different, and you have to figure out where the orders in between, and it can be really challenging. So definitely, you know, make sure you search the state governor's website, do the same for the county, local healthcare, local health department. I would even, if you can't find something in between, call the county and see if they can provide you with those orders. They should be able to. There are times that the governmental order will go from a must to a should and then back to a must. So never assume that there is a continuous link between orders. There's also times where there's like a full-on gap. Like in certain jurisdictions in like the summer of 2020, certain things were completely lifted and then brought back into the fall and continued for a long time. And you want to make sure that you're calculating things properly. And so you want to make sure you have that full timeline. Go to the next slide. So this is going to be before you file, but also afterwards, right? So your client gets audited, they come to you, say they had gone to an ERC mail, and they're like, oh my gosh, I just got audited, now I want to come to you, practitioner, PA, EA, attorney, whoever. You know, I was impacted, but I never went through this stuff before. What do? You're going to be interviewing that client and going into a lot of detail about stuff that happened years ago. The sooner you can do it, the better. If you file these claims and you have not done this yet, I would say have a quick conversation with your client now while things are relatively fresh versus waiting 2 years when things might not be anywhere near an ability to recollect. But you're going to be going through and making a determination of like, okay, were you essential? Were you non-essential? What happened right when the pandemic happened? Were you able to be open? Were you not able to be open? Were you able to be open subject to social distancing? What did that look like for your space? Do you have a really small space? Do you have a really big space? We have an associate who is very young and just hasn't had a ton of experience, and so didn't know that a 3,000 square foot space was actually pretty large versus a 300 square foot space. Just not understanding like what that means when you're talking about 6 foot social distancing. And how does that all kind of come into play? But making sure that your client is explaining to you exactly how that business was modified and then linking it to that governmental order that says, okay, you are non-essential, you are closed, you had curbside delivery only for this period of time. So now we're looking at nominal portion. Now we're looking at 2019. And then now you could be reopened. Now we're looking at nominal effect. And how did that impact you? So going through all this stuff with your client is so, so important because, again, like we've said now many times, it's a facts and circumstances test.
All right, so I saw this question come up a couple of times in the questions. What are we talking about as far as timing here? So, again, built on existing tax law, the assessment statute expiration date is 3 years from the date of filing the original return. The unique feature of employment tax returns, though, is that by operation of another code section, they are actually deemed filed the following April 15th after they're timely filed during the quarter's or the month after the quarters. So claims related to 2020 need to be audited and assessed by April 15th, 2024. And then for quarters 1 and 2 of 2021 that were deemed filed April 15th, 2022, now they need to be audited and assessed by April 15th, 2025. Congress added a couple of years, 2 more years for quarters 3 and 4 in the American Rescue Plan. Therefore, those need to be audited and assessed by April 15th, 2027. There is some rumblings. I think the Biden administration put it in their budget that they would like to increase the statute of limitations for all the quarters to give the government more time to come back and take a look at these again. There's, almost 1 million that just now need to be processed. That's not even counting the ones that were previously processed. So we're talking about trillions of dollars here. But that's the timing. So really, we anticipate audits happening now if they're going to happen, because you've got to get in there on 2020. Now, is 2020 the more the year you want to focus on? Maybe not, right? It's only worth $5,000 per year, and the theory of the case may be more easily established in a calendar quarter related to 2020. Who knows? Refund statute expiration date, not necessarily relevant to audits, but just to put on your radar. Claims related to 2020 then need to be filed by April 15th, 2024. Claims related to a calendar quarter in 2021 need to be filed by April 15th, 2025. Back to Rebecca.
Back to me. And like we said earlier, with the statute of limitations, if it does get extended, it gets very tricky when you're talking about income tax issues, especially for these big people who are claiming this stuff is going to get rolled back. You're talking about additional tax paid and how do you deal with that and all of those things. So we don't have a ton of time to go through this, but these are the things that Peter and I, like a list of your favorite things. These are the things that we think are top issues right for IRS audit. And I think we had 11, so we couldn't do a top 10, but it's like a top 10 plus 1. These are things that should give you pause. These are issues that you should certainly be aware of as practitioners. Obviously, defense is very different than offense, but we're hopefully teaching you this to make your offense game better so you won't have an issue on defense. The top 10 issues, plus 1, is supply chain claims. And I actually don't think we go into this too deeply, so I'm just going to say something really quick about supply chain. There's one FAQ about supply chain, and I guarantee you the IRS regrets horribly about putting that in their guidance. People are relying on supply chain because they couldn't get, a microchip from China, or because stuff just took longer, or who knows. But in order for a supply chain claim to work, you need to know your entire supply chain and know that the reason that you couldn't get that essential good, that you couldn't get it anywhere else, and you couldn't get it from your supply chain was because of a restriction from a governmental order. So you need to understand that the warehouse where the widget was made had to be restricted, and they normally had 300 people working a day, and because of social distancing, they could only have 150, and that 150 could only output 78 widgets a day instead of 120, or whatever. You need to have some sort of an understanding of why this is so impactful to you. And that is very rare. I actually think we've only seen it maybe once, twice. There are a lot of people that call in and mention it as a reason that they are eligible, and we have to explain all these steps, and then I think they prefer to go elsewhere, but which is fine. It's not fine for the world, but it's fine for us to not have to deal with claims that really can't be verified. Offsets, making sure that things are being calculated properly. There's been a few audits that we're aware of, again, not through our firm, where PPP wasn't calculated the proper way, and so that gets added back in. Analysis of multi-jurisdictional operations, how you deal with these types of organizations that operate in multiple states. Is it the same trade or business? Do the restrictions extend? There's FAQs on it. If you have questions on this stuff, we're happy to talk about it, but we could probably give you a 2-hour presentation just on that. So we won't unless there's a lot of demand for it. We should have made a poll question. Maybe the 14% will be interested and we can do a small group analysis on the multi-jurisdictional operations. Misunderstanding of control groups. We see that all the time. Disregard of family attribution rules. We definitely see those issues. Q3 2021 claims. Unless there's a reduction in gross revenue, Q3 is very challenging in the continental US. Most governmental orders were lifted by Q3 of 2021. Be aware of those. Owner and deemed owner wages. Full-time employee analysis, the rules change about qualified wages, whether or not you have a certain number of employees, which is either 100 for 2020 or 500 for 2021 for full-time employees. We'll get into how to count that, but it aligns also with control groups and who you have to count in order to get the right number. And we've definitely seen issues with that. Insufficient theories of eligibility, I think, go to the Q3 and the supply chain claims. So I probably could have made this a top 10 setting. Incomplete, more than nominal effect analysis. Nominal effect is hard. It's the hardest of all the tests. Making sure that you are comfortable with your client's assertion that there was more than a nominal effect on its ability to provide goods and services is really important. Make sure you have some sort of metric or some sort of item that you can say, okay, before the restrictions it was this, with the restrictions it was that, and then once you got past the restrictions, things opened up a little bit, it did better still. And then employee versus independent contractor reasonable compensation. This was the extra one, and it's because these are payroll tax audits. These are not income tax audits. I've talked to many clients, potential clients, lawyers, what have yous, where people are concerned that filing for the employee retention credit will trigger an income tax audit. It's going to trigger a payroll tax audit. And a payroll tax audit can include things like whether or not you are an owner of an S Corp and you're taking a reasonable compensation, or whether or not you are treating employees properly and classifying them properly. So this is kind of like an added item in an ERC audit that we've seen come through. That has nothing to do with ERC. It's just something that payroll tax auditors are trained on, and when they're looking at a company, it's something they're going to look at.
All right. So now, Jason, do you want to do another poll question?
That sounds good to me. We'll get the 4th poll in now, and we'll have 2 more after this one. 6 total polls in our time, so we'll have 2 more in our remaining time after this one. This is poll number 4. The question, do you think Congress will extend the statute of limitations for ERC audits? Go ahead, get your answers in. We'll leave this poll open for about 40 more seconds. Don't forget to hit the submit button to confirm your response. Again, this is poll question number 4. There's no wrong answer to this poll. Go ahead and get your answers in. Don't forget to hit the submit button to confirm your response. We'll have 2 more polls after this in our remaining time, and we'll close this down in about 15 seconds or so. Get your answers in as quickly as you are able so we can go ahead and close out of this poll.
This is us genuinely curious what people think about this. I don't know if this is what you talk about at your dinner table, but it's what we talk about it, amongst ourselves, and sadly with our spouses, sad for them, exciting for us. But we're just curious to what people's thoughts are, whether or not this will actually happen.
So with that, we're going to close out of the poll. We'll see what everybody thinks. Poll will close in 3, 2, and 1. 63% of the audience says yes, they think that Congress will extend the statute of limitations.
Interesting. All right, so these last couple slides, and then we'll try to answer some questions if we still have time. We're just digging a little bit deeper into some of the technical issues that we certainly have seen the IRS ask about in audits, but also the ones that can have the biggest impacts on qualified wage analysis, eligibility analysis, making sure the numbers are right. The big one is controlled groups of corporations. And so Congress, from the CARES Act through all the legislation, references Section 52 and Section 414 related to affiliated service groups. And they're basically saying, mind these rules, and it's going to change the way that the analysis is done. And it's not even, it's different depending on your method of eligibility. So big picture, controlled group of corporations. Parent subsidiary is one. So if a parent owns more than 50% of a sub, they're going to be considered a single employer for purposes of ERC. There's also brother-sister controlled groups, and that's the one we're going to drill down on because that's the one that is sort of the least obvious, but that is going to affect eligibility. There's also combined groups where you've got some parent subs, you've got some brother-sister, and you've got to think through all those things. What it's ultimately doing is saying, this is the actual employer that you're going to consider for ERC, and we don't care how you papered these groups, and while they may not feel like they're together for purposes of credit, they need to be. If you have a controlled group, the analysis for gross receipts includes everybody. So, if you've got a controlled group that may not feel like one, but you've got a husband and wife and they're working together and now you've got these two family businesses that are together. Well, maybe one company did really poorly, but the other one didn't. And you've got to pull them all in to do that significant decline in gross receipts analysis. That is absolutely going to be something that they're going to want to look at. Analysis is a little bit different when it comes to the suspension of trade or business operations. That's second method. In that situation, we're looking at trade or business operations and understanding how they were restricted. You may still need to pull in these groups that are associated as being within a controlled group for purposes of employee counts and other things. So you've got to keep it in the back of your head. Okay, what is my controlled group here? There's also special issues with aggregation for recovery startup businesses. So even though I didn't start this one business until after February 15th, 2020, well, I had these other things going on, and there's look back rules related to that $1 million on average threshold to be able to say, yes, I'm a recovery startup business, that you've got to take into account. And just to make this stuff even worse, and we'll talk a little bit more on another slide, it's not just understanding who owns what and at what percentage. You have to layer on top family attribution rules, both here and then in the wage computation that we'll talk about also. So this is again where this stuff gets really hard. It's because Congress referenced these code sections, to make sure that they are taking care of the people that they intended to take care of. These code sections are sort of anti-abuse rules, right? Section 52 at its core is making sure that you can't paper around the idea that we only want to give credits to certain targeted people. 414 is making sure that qualified plans are treated, employees are treated similarly, and you can't pop up highly paid people in one organization and do some stuff in another. I mean, that's what's going on here. And Congress, when they did the CARES Act, grabbed these. The big one, people sort of conceptually understand a parent subsidiary. If you have one thing owning a majority of another, got it. it's harder when you're dealing with brother-sister controlled groups, and it's a two-part test. So in order to establish a controlled group between two entities that, you know, aren't necessarily owned in the same way, you've got to pass two tests. One is a controlling interest test. So that generally means that 80% or more of the stock of each corporation, but only of such common owners, and we'll go through an example, own stock in each corporation. So 80% test, controlling interest test. Then you also have to get through the effective control test. So of those 5 or fewer owners, and that's what we're testing here. It doesn't say that. We're looking at 5 or fewer owners. Do they own more than 50% of the stock of each corporation? But again, only to the extent that stock ownership is identical with respect to the corporation. So let's take a look. And these examples come from the regulations. But in this situation, you have two corporations, Adams Corp and Bell Corp. You have 4 shareholders, A, B, C, D. So the controlling interest test is satisfied. Again, that's the 80% test. At least 80% is satisfied because the same 5 or fewer owners own at least 80% of the stock. They both own 100%. All 4 of them own 100%. Controlling interest test is satisfied. Then looking at those same 5 or fewer, the effective control test, the more than 50% test, fails. And these are the highlighted ones. I don't know if it comes through, they're highlighted red. This is the effective control test. It only adds up to 40%. So in this situation, I don't have a control group. But what more often happens with these ERC claims is they come in and they say, well, here's the universe of everything. It's never quite so clean. And so in this example, you've got corporations P, W, X, Y, and Z, and I've got 5 owners, A, B, C, D, and E, but not everybody owns a piece of everything. So a brother-sister controlled group only exists between P and W in this situation. X, Y, and Z do not join the controlled group. Why? A and B are 5 or fewer individuals. That's checkbox 1. A and B have a controlling interest. Their interest in P and W is 100%. They also have effective control, and that is adding up 51% and 45%, and that's more than 50. So their effective control is 96%. This is, you know, relatively mechanical, relatively straightforward, but challenging. And, you know, I don't think that ERC mills are really working through this stuff. But it is, again, relatively straightforward, and certainly the revenue agents are going to ask about what is owned by the owners and trying to evaluate control groups. This is the family attribution rules before I throw it back to Rebecca. So this is, you've got to be asking about parents, grandparents, spouses, children. We get really weird looks when we're talking to clients and we're asking, look, do you have any kids under age 21, right? That's just the way these rules work. And, you know, so there's automatic attribution in situations, and the attribution and the effect of what I'm working through is how to evaluate ownership in a particular entity. Because if you have a husband and wife who owns something, well, the starting point is there's automatic attribution, meaning husband is going to be treated as owning wife's shares, you know, wife's going to be treated as owning husband's shares. There's an exception though, and you know, it's a 4-part test here that, you know, if the spouse really doesn't have any participation, they're not involved in management, they're not, you know, otherwise owning stuff, their stock's not subject to certain restrictions related to minor children, well, now you can avoid that automatic attribution. There is no such exception, however, for minor children. So, you know, this is a weird situation where you could have husband and wife who otherwise satisfy the exception to the automatic attribution rules, but because they have a child who is under age 21, husband's business and wife's business are going to be treated as one employer for purposes of ERC. That's conceptually really hard, right? But that's how this stuff works. You've got to consider parents, grandparents, adult children. Those rules are a little bit different, and they actually have to own more than 50% before you start pulling in family members, but again, something you've got to work through. Legal adoption matters. Relationships established by marriage do not matter here. So Rebecca will talk on, it might be the next slide, about deemed donors. In those situations, those step and in-law relationships do matter. They don't here, so it's a little bit straightforward. Second bullet point here, the interest from more than one individual can be attributed at one time. So you could have a situation where mom's interest can be attributed to dad, who has 60, so now he's at 90, so that's now more than 50. And now you're being attributed an adult child's. That's just how these rules work. So you got to learn them and appreciate them. Interest attributed to one person for purposes of evaluating their ownership doesn't remain. So like in the previous bullet point, if you get dad as treated as owning 90%, that's for purposes of dad. When you go and evaluate for someone new, you don't keep dad necessarily at 90%. You go through and do the analysis for that other individual. That's what the bullet point represents there. Just be aware of this stuff and be prepared to get in the weeds on some of this stuff if you're being asked about it in an audit. Back to you.
Okay. Family attribution rules and deemed owner wages. So if you are a majority owner and deemed owner, so that goes back to Peter's items, you cannot have qualified wages. So deemed ownership is conveyed by family relationships. Majority owner is child or descendant of a child, brother and sister, stepbrother, stepsister. You can read the slide. But what's interesting with these types of things, and what we've actually seen other people make mistakes on, is what if there's a partnership with 3 individuals and they actually are like an S corp and they take wage. Those wages can count, and that can work out for people in order to determine whether or not those wages should be considered qualified wages. Go to the next slide. Oof. Large employer and qualified wages. Okay, so what does this mean? For the original ERC, the CARES Act, so I know we're really short on time. Do we need to do another poll? Where are we on the poll?
I was just going to jump in and say we should do another poll right now. We're going to go ahead and launch poll number 5. We'll have one more poll after this one. Go ahead and get your answers in the question. Do you think ERC mills should be criminally investigated? Yes, no, or not applicable? We're going to leave this up for about a minute total, so that's 45 more seconds.
Again, this is just our curiosity to see where you all are, what your thoughts are. We'll keep our opinion on the subject.
Again, this is the 5th poll. We will have one more after this one in our remaining time. Go ahead, get your answers in. Hit that submit button when you have your response up. Again, this is poll number 5. We will have one more poll in our remaining time. So get your answers in, hit that submit button to confirm. Got a little less than 10 seconds of having this poll up, so get your responses in as we close out in 3, 2, and 1. And about 67% of the audience said yes.
Ah, look at that. All right. Were there not applicables or no's?
There were 16% no's and 17% not applicables.
All right, interesting. It's hard to know because we're so much in this space of what other people's thoughts are, but we get really upset when we see people do things the wrong way, or when somebody calls me and they're like, I was pre-approved, like they got a credit card, versus looking for a tax credit that you cannot be pre-approved by. Okay, so the CARES Act said that this is for small employers. All wages are qualified if you're eligible if you have under 100 full-time employees in 2019. 2019 is the year you're looking for. this can be really beneficial to people or really screw some folks. So it really depends on whether you had a lot of employees in 2019 or not. And then in 2021, the rules changed from 100 to 500. So all wages are qualified if you're an eligible employer and you had 500 or less full-time employees in 2019. You calculate a full-time employee by counting all the employees you have that worked 130 hours or more each month, and then divide by 12. So seasonal businesses, places like that, are going to benefit as well. We're going to have some zeros in there. Now, what if you have 504 employees in 2019 and you are eligible for Q1 of 2021? What does that mean? If you paid people not to work, then you can count those wages as qualified. That's what's going to be important, and same thing for 2020. So those numbers are important if you're trying to get everyone qualified wages. But if you're over that 100 number and you paid people not to work, so if you're a retailer and you have 30 people on staff and you had to do curbside, so you went from having 10 people at a time to 2, but you still paid your folks, or you still paid them health insurance, which we didn't really get into, but health insurance, an employer portion of health insurance is going to be considered a qualified wage. You can still use those dollars to get the employee retention credit for, large employers. And some large employers that, took care of their employees during the pandemic are really getting some very large credits through this process. I'm going to go to the next slide. PPP and offsets. Make sure you're not counting the same dollar twice. These are things just to be aware of. You're looking at the 941s, if you're looking at like R&D credits, you're going to need to ask that question specifically. It's not on the 941. Other types of credits, make sure your organizer encompasses all of these items so that you're making sure you're being accurate in the claims that you're submitting to the IRS. But this is something that an auditor is going to like. Right? It's not squishy like nominal effect. It's something very clear. Oh, you got $20,000 of PPP. You paid Peter $20,000 in that period of time that they were covered. You don't get any ERC for that period. It's black and white. Next slide. This is back to you. It's 11:22.
Okay. So this is something we've seen revenue agents ask about in ERC audits, where they basically want to see the 1040s of the business owners to make sure that they've ultimately picked up income if it's a pass-through entity. This is the operation of code section 280C, which basically says if you get a credit based on wages paid, you lose the deduction for the wages up to the amount of the credit, effectively making ERC taxable. So the corresponding tax auditors, I'm sure we'll be looking at.
Okay. Last thing of things to think about as far as what could get pulled into an audit, like we said, reasonable compensation and whether or not there's misclassification of employees, back in controversy days, more so than what we're doing right now. But we would see this stuff a lot. And, the IRS knows that lots of businesses misclassify employees. And so it's a way for, them to correct that mistake. If you are getting a new client and you see that there's some sort of misclassification, there is a really good voluntary disclosure program to fix this mistake that the VCSP, and it's really, really beneficial for businesses that want to, make it right before there's an issue. Okay, I think that is the end of our presentation. Nope, one more.
Nope.
The end.
We do have a little bit of time for Q&A, but right now I'm going to go ahead and launch the final poll, if that's all right.
Yeah, please.
That sixth and final poll is now up. Get your answers in. We'll have just a few minutes available for a quick Q&A. Peter and Rebecca, if you are able to see, I flagged a couple of the more common questions that came up in the questions panel, so you should be able to see those. I'm happy to read them aloud as well. But I also know that you are able to see questions that have been asked in the questions panel that have come in from the attendees. A quick note to everyone who asked questions, of course, there are quite a lot of you in the audience and only a few minutes remaining. So all of your questions may not be answered on air, but all of your questions and comments will be forwarded over to Peter and Rebecca at the conclusion of the webinar. Poll number 6 is live. We'll have a few minutes for Q&A, and then we'll go ahead and get ready to close out with our remaining time. So get those answers into this final poll. The question, do you think PEOs should have the ability to tell clients they will not file ERC claims on their behalf? We're going to close out of this poll in 3, 2, and 1, and 63% of the audience said yes to that poll question.
Interesting. That's a surprising fact. The PEOs I don't think Congress intended how this would work with a PEO, because the PEO has to file their 941s, amend their 941s, and how much diligence do they have to do in order to file based on their clients. That was just a fun thing to think about. Just before we get to questions, just 2 seconds to say, Peter and I have been doing this for the last 3 years, 3 years and 2 weeks, I think, something along those lines, where we started really getting into the CARES Act, and then the next CARES Act, and then all of the things that kind of came from it, changing our practice area, talking to our spouses about PEOs, and whether Congress has the authority to extend statute of limitations on returns that have already been filed. This has been our life, and it's an area of law that is going to go away, especially if that statute of limitations is not extended. All that to say is, right now, we are like Def Leppard in 1987. We will never be as cool as we are right this second. We are happy to answer questions. This is why we think it's important to do these talks with CPAs and other people who are, frankly, our competitors. But we want to make sure everyone's doing it right, and we like talking about it and doing it, and we just want to help people do it right. So feel free to reach out to us. You've already filed your question. We will talk about it maybe longer than you want us to, but we're happy to provide that. And then, Jason, I can't figure out what's flagged. If you want to read them.
I can see some. I mean, nonprofits can file for ERC. It's a question about focusing more on eligibility or qualified wages. It seems to be both. I mean, they're really tracking what we've seen so far, that QA 70. So they're looking at eligibility. They're looking at the computations. Let's see what else. There's 2 that I saw. Threshold.
We have time for maybe one, maybe 4 questions.
One more question. All right, Jason, pick one.
Oh, Peter, you already have the questions up. I'll defer to you.
Yeah, there's a question about, is there a threshold amount that they're looking at? No, it's not a situation where, like PPP, they came out and they said, we're not looking at, a certain amount or under, over. No, there's been no guidance as far as that goes.
With that, I think we actually are just out of time, as we need to make sure that we wrap up on time. But rest assured, we will send over all the remaining questions to you at the conclusion of the webinar. So with that, we're going to go ahead and start wrapping up. First, of course, a huge thanks to our presenters. Peter, Rebecca, thank you so much for sharing your expertise with us over the last 90 minutes. And thanks to all of you in the audience for your participation and attendance. CPE will be issued by our team here at CPA Academy by the end of the day today. CE credit we will register with the IRS at a later date. And again, for questions about the reporting of CE credit, please consult our CPA Academy FAQ page on our website at cpaacademy.org. Webinar evaluations for today's course have gone out by email, and you can also access those evaluation links in your CPA Academy My Account pages. So with that, once again, a big, big thanks to our presenters, Rebecca and Peter, for their expertise and for being with us for the last hour and a half, and for all of you for your attendance and participation. We hope to see you all on a future webinar. And for now, have a fantastic rest of the day. Thank you, everybody.
Thank you.